All right, we're live.
Yep.
How's it going?
Good, Adam. Good to
So
talk
you
to you.
said you've done this once before, right? So who else have you conversed
No, I'm
with?
not. No, I'm.
live?
Oh, no. I'm saying there's only one person that I've ever met in person or ever seen face to face that follows me on Twitter. At least there's other people obviously that read my blog, but
Right.
most of the people I know do not seem to get into finance and investing too much, which is part of the reason I started the blog, because I didn't have too many people to talk to about this stuff or tell me if I was wrong or if I was crazy. So I figured
Well,
I'll start talking on the web and see what people have
in the
to say.
category of careful what you wish for. I think
Yeah.
you've
That's
gotten
right.
lots of engagement.
Yes.
So who else have you chatted with face to face?
Oh, no. You're the first one that I've chatted with face to face.
I see. Okay.
I have a friend from college who's an investment manager in Virginia, and he's about the only one I've really talked to in any kind of detail about this.
Gotcha. So I've actually been looking forward to this for quite a while, because you sort of exploded onto the Twitter scene. When did your first post was just last year, right?
Yeah, my first post was March of last year. I didn't join Twitter, I think, until May. I wanted to actually get used to blogging before I tried to get other people to, read it, because I was afraid I'd be terrible at it for a little while. So I wrote a few, and then it was like, all right, this is reasonable. I'll tell people about it now.
And then when did you start getting some engagement? Because I think a few really big bloggers started to tweet about you at some point.
Yeah, in the fall, I started getting engagement. You were actually, I think, my 7th follower, which was nice. You were the first professional that followed me. But no, I think my first post that really took hold was the one on stochastic efficiency. And that got quite a few people to pay attention to it. And then come around November, Taylor Pearson retweeted me. Nick Majuli retweeted me, and that brought a lot more attention into what I was doing. Among others, I'm leaving other people out. I apologize for.
Yeah, no, I mean, you've had lots of engagement from some of the Twitterati. So let's go back, and I'm very interested to learn, because you came to investing as a second or third. I guess it's not really a career for you, but it's, you didn't start out as an investor. You're not a professional investor, as far as I could tell. So how did you come at this?
So I'm an engineer by degree and trade. I guess I started investing in college when I went to grad school too. I got a master's in business as well, but just, you take general finance classes and you get intrigued and think you know what you're doing. So I bought a few stocks, but I gave up on that pretty quick, because I think I wanted the money to buy something else. I really got into, I guess, reading and learning more about investing through real estate, not from owning it, but from the real estate crash, in 2006, 7, and 8. It was intriguing just seeing people I knew buying houses, and it didn't necessarily make a lot of sense to me from a rent perspective. So I started reading a lot of stuff online about real estate and what made sense from a macro perspective and where the issues were. And then when the crash happened, I was like, all right, this whole thing is actually quite more interesting than I thought. I mean, it's a very big problem and a challenge. As an engineer, I'm drawn to challenges. I'm drawn to, big problems and problem solving. And I realized that it just was very intriguing. So I started reading more and more about it, learning as much as I could. I got through all sorts of rabbit holes at times. I mean, I would get into technical analysis and tweak through it for a while and thought it was good. And then I was like, I don't know, this may not work. And fundamental analysis, but they would all be fleeting. So
what kind of engineer are you? What's your engineering background? Okay.
I'm a mechanical engineer by degree, but I manage a lot of different kinds of engineers at this point. So I can probably converse in a few different engineering speak if I wanted. I do buildings.
What industry are you in then?
Buildings and facilities.
Okay. Gotcha. Okay. So that's you went through a few permutations of different investment approaches. And then I guess at some point you stumbled on Ed Thorpe.
No, I actually stumbled on Ed Thorpe after I'd come around to some of these ideas.
Okay.
I guess my epiphany type moment, or my thought process on this, was I came across the idea of the geometric return, and how, there's the difference between if you just average every year's return, you don't actually get that. So there's plenty of posts about that out there in the world. And I started thinking through that a little bit, and thought through the idea that individual stocks also have the same concept, but their geometric return should be quite a bit less than the return of the market itself, because the market has a lot less volatility than individual stocks. And so I started trying to think through the dynamics of what that was, and how that would play out, and why does that mean then that does the market outproduce individual stocks, and is it something to do with the nature of the geometric return? And I came to as I'm thinking through that process, I'm kind of realizing that, okay, over time, if you have a portfolio of stocks, the stocks are going to become out of weight. Like if you start out with an even portfolio, if you give them time, they're going to unbalance themselves. You're going to concentrate wealth in certain areas. And as that process happens, then the standard deviation of the portfolio grows. So I'm thinking through this and thinking, okay, if that's the case, then if I just buy a bunch of stocks and never touch them and leave them alone and just let them be, the whole thing over, long periods of time is going to become concentrated in a single stock. And it's going to become more and more like a single stock as opposed to a portfolio of stocks. And thinking through that kind of made me think about the idea, okay, so why is it then that the actual index does so well compared to individual stocks? Why does it actually get a higher return if it's just composed of the same stocks, but it trajects at a higher path upward than individual stocks do? And I was like, well, the only real difference here is that the components change over time. Like it's not static, and you're moving your wealth between those components depending on the index you're dealing with, different rules. But and effectively that's keeping the weighting somewhat balanced. And so thinking through that, I was like, all right, well, this is interesting. Is that part of the reason that stock indexes actually work really well? Is it a lot of the reason is just because they're rebalanced every so often? Does that actually provide extra return, or I guess alpha, you could say? So I just started poking into that to see if it was legitimate, and it kind of seemed like it was. I've got a blog post about this, the why does market investing work? And that's kind of where I started with this. And so when I was like, all right, well, that's I've never seen anybody discuss that concept or think through that concept, that stock markets work not just diversification, but you have to rebalance that diversification. That if you just leave it diversified and untouch it, it's gonna dissolve. And so when I was thinking through that, I was like, all right, well, is there a way I can do anything with that? Is there a way that you could actually acknowledge that that's true and design a strategy that maybe doesn't just use random stocks, but uses the whole gamut of investment stuff out there in the world to build a portfolio that kind of works around that same concept? And
so that's when you sort of went into the asset classes.
Yeah, right. So that's when I was like, all right, so
gold
exactly. So my thought process there was, okay, so if I'm trying to do this, if the goal is to maximize the geometric or compound return, then I need to keep standard deviation low and tight. And the best way to do that is to find uncorrelated assets or negatively correlated assets. And the problem I see with a lot of investing is that there's just a lot of assets that are quite correlated with each other, especially in times of crisis. And so if you're holding a lot of, people think that they have a nicely diversified portfolio, but when you get down to it, is it really that diversified when it really matters? And a lot of assets become fairly correlated. Now, obviously, gold and long-term bonds can also become fairly correlated at times too. There's no perfect answer here, but if you're just going to look in a big picture, I figured that was the first two places to start. So I said, all right, let's just put together a portfolio that just has those three.
So were you looking at Harry Brown's permanent portfolio concept at all there, or did you arrive?
It wasn't conscious at the time. I'd read about Harry Brown's permanent portfolio. I wasn't like, oh, this should be Harry Brown's permanent portfolio. It was more just picking asset classes. I mean, I poked around real estate, like REITs, to see, and I poked around currencies. I poked around a handful of other things just to kind of think, are these really uncorrelated? Do they work? Part of me too. I mean, if I was a professional, I would probably do more than 3, but I'm not. I only have so much time on my hands, so I can only get so complicated with this. Like I'd really love to look into, some options or tail hedging or some of the fancy things, but that's probably beyond my bandwidth to really get too deep into that at the moment. So
okay, so let's jump into exactly what this is that you've landed on, this geometric rebalancing concept.
Okay, so the goal is to it's twofold. It's to keep the diversification, the effective diversification high, and keep the standard deviation of the whole portfolio as low as we can. Not as low as we can, because I'm not trying to do a minimum variance portfolio. I'm trying to still trade off a little bit on the return side. So I'm open to taking some risk if I think it's going to pay off, but to keep it low as we can, so that for anybody that, I assume most of your audience is going to understand this, but you
can go as technical as you like. Our audience tends to skew pretty technical.
But for those that aren't on top of it, the arithmetic return, which is the average that most people are used to dealing with, is always going to be higher than the geometric return. The geometric return comes off of from volatility drag. So if you go 10% up and you go 10% down, most people think right away that's flat. But in a compounding world like the stock market is, 10% up and then 10% down, if you're multiplying it together, ends up down 1%. So the goal is to keep those up and down, up and down, up and downs tight, as low as possible, because 35% up and 35% down is down around 10%. So it's much worse. Like it gets, the wider your up and downs happen, the worse your returns are going to be. So I felt like that the goal is to try and keep the portfolio balanced, to keep as little volatility on the portfolio as possible, but still, have it positioned to get return when it's going up. And then the second side of the coin was, I thought, okay, so if there's a rebalancing premium, like I was talking about with the market indexes, I would like to rebalance as often as I can. Fees obviously get in the way of that, but I should try and rebalance all the time. That concept, for people that may know, is a bit like Shannon's demon, which is, there's a lot of that going on in what I'm trying to accomplish, that Claude Shannon came up with, but then never tried to implement because he thought fees were a problem.
So when you're optimizing the portfolio, are you explicitly incorporating a term to maximize the rebalancing bonus? Or does that come naturally from the way that the portfolio is formed and the fact that you're forming portfolios from structurally uncorrelated assets?
I think it comes naturally. I'm trying to pick a portfolio that would not exactly maximize the geometric return, but maximize it with a bunch of protection and error for the fact that I don't exactly know that the inputs are correct. There's flaws and all that stuff.
So maximizing the geometric return. So I think that's something to pause on, because that confused me for a time, because the optimal Kelly portfolio is the maximum Sharpe ratio portfolio.
If you leverage it, it is, yes.
And so if you don't leverage it, you're finding the max geometric mean portfolio so you're forming a geometric mean frontier.
Yes.
And you're just simply solving for the portfolio that maximizes the expected geometric mean of the portfolio.
Yeah. So if you look, I've got a lot of charts on my blog with little bar charts that kind of show two assets and how they correlate with each other. And yes, what you just said is exactly what those charts do. They solve for the peak of a geometric return frontier. I don't acknowledge that yet. I will. That's coming, but at the moment, I've tried to keep that a little bit. I didn't want to confuse people with too much geometric mean frontiers. I was just trying to show, similar to a gambling structure, of just if you're going to maximize returns, there's one answer, and that's that. This is how you would solve it. I'm in the middle of writing a bunch of posts right now about why real life doesn't necessarily mean you go for the peak. That the errors in your measurements and the errors in your forecasts actually mean that you're better off aiming left of the peak more conservatively. And how you do that.
Yeah.
Is
So I want to
complicated,
dig.
but
Yeah. I'd love to dig more into that. We've spent a lot of time on that as well, whether through some sort of multivariate resampling or bootstrap resampling or something like that, to get a better estimate of the tails of the distribution. And it does change the shape of the frontier. But in order to form a true frontier, you need some kind of return estimate. I'm wondering, and you did go into some of this in sort of an illustrative article where it seemed like you used the earnings yield for stocks and the current, I guess, constant maturity yield for bonds.
yes,
To inform that. Is that how you think about the problem in general?
Yeah, for right now it is. I did, you go back into my earlier years of just looking at trying to learn what I could about markets. I did a lot of just testing to see how fast you could do to figure out actual returns, or what it would take to learn different parts of things that you would need for portfolio construction, be it covariance or standard deviation or returns. And returns, from what I could tell, were almost impossible to find. You need just way too much data. And at that point, what are you learning? Because if you have to go back multiple years to feel comfortable with it, a lot has changed, and the data from years ago doesn't really matter. So because of that, I didn't feel like there was any reasonable way for me to come up with a price type estimation that could be trusted from off of returns alone. So some of this goes back to looking at just like economic indicators from the real estate time. I had poked around a lot of different ideas of how do you use macroeconomic stuff to figure out a projection of the market, which is going to be absolutely terrible over short term. I fully acknowledge that. I mean, my own projections had no idea that the market was going to go up 40% over the last 2 months or whatever it's done, and totally missed that move. But big picture is hopefully that it's close enough, to getting those kind of returns. So what I put on the blog, which is not exactly what I use my own strategy, but was earnings yield, along the lines that earnings yield is probably roughly what you're going to receive over time, and it plays back to the geometric mean concept. So earnings yield is what you're going to receive over time. So if you add half the variance to that would put you in the neighborhood of where the return for the asset should be.
So I wanted to dig into that a little bit, right? Because it's interesting how you approach this, and you explicitly did not add back the volatility of the index, but rather the volatility of individual stocks. And so because really the estimator you're using, earnings yield, is its own time series, and it's different than the time series of prices, right? So you've got a distribution of the growth in earnings yield, or not the growth, but the time series of earnings yield. And so I guess you're just sort of using the stock prices as a proxy for that, because the variance of stock prices, right? The earnings yield is the current earnings divided by essentially price or market cap, but let's say price.
Sure, right.
And so earnings are fairly stable, and so the vast majority of the variance is derived from movements in price, right? And so, but you didn't use the variance of the index; you used the average variance of the index constituents. So walk through that.
So one thing, this is a theme that pops up through my blog, is that the stock index is not the same as the stocks themselves, that it's not going to have the same properties, and it's not going to behave the same way. So the index is a portfolio of other stocks. And I mean, in a way, it's just man-made. It's just what we come up with to describe and track what's going on in the market. But the real action is actually at the stock level. So if you step back and say, okay, we have this index, and like I said, at the beginning, I think that the market index works partially because it's diversified unto itself, and that it is able to shrink most of the time, not all the time. You have your high volatility times that it doesn't really shrink volatility much, but it's able to shrink volatility, which helps its long-term, growth through the geometric return. So if the arithmetic mean of a index is roughly the average of all its constituents arithmetic means, that means I would, and the PE ratio or EP ratio is also that same situation. If you're going to look at an average stock, the average stock's arithmetic return is going to be roughly 4% higher than its earnings yield. And I've poked back through history to kind of check that, and that seems to be generally speaking the case. I mean, the earnings yield is somewhere around 1/15 or 1/16 over time, somewhere in that neighborhood, which turns out to be about 6 or 6.5%, somewhere in there. And you add 4% to it, and it gets you in the ballpark.
Yep.
So,
okay. I mean, it's a weird thing because the actual earnings. So if you think about it as like a distribution of cash flows, right? That's what you're pricing in with the earnings yield. Is eventually those cash flows are going to be paid out as dividends or as share buybacks, and or there's some terminal value of the stock when you sell it, right? So I guess the earnings themselves are probably don't have that level of, like, if the distributions came out without volatility, like you just had, a 5% distribution per year, right? Then I guess the implication is, right, the earnings yield has zero volatility, or the distributions themselves have zero volatility, right? It's the price.
Yeah. No, that's a fair point. I can't. Yeah, the earnings themselves have volatility, and so how does that play into the mix? Yeah, I think it's a cleaner example when you look at it at bonds, where like treasury bonds are, you're going to get a coupon every month. The value of the security may change, but the value.
Well, that's a really good example. So there's no, with a treasury bond, for example, there's no ambiguity or variability in the coupons, right? There's, in other words, there is no standard deviation in the coupons. So if that's your expected return, then why are we adding back half the variance
with bonds?
Yeah, or with but I'm just we're using bonds.
Let's talk about through bonds, because I can cover that, and so if you're going to have a bond and you're expecting to get 3% coupons, 3% yield over 10 years, and then at the end of it you're going to get your principal back. Over that time, of course, the value of that bond is going to go up and down because interest rates are going to move all over the place. Now, the end value that you're going to get to doesn't make a bit of difference, because you're going to ultimately walk away with, your $130 or whatever that comes out to be, somewhere around there. But so that growth is effectively known up front if you hold it all the way through. The issue, however, though, is if you look at the price, like if you were to just take that security and price it over that 10 years, it's gonna jump. It's gonna go up and down all over the place. So, if the security goes up and then down and then up, and you end up back flat, if you go back and look at the actual returns for that product over that time, they're going to be higher. So, like, you could do this. You could just go take TLT. I mean, we're kind of at lows right now. It's a bit hard to find that. You have to go back in time. But if you go find a decently long period of time that starts at one interest rate yield and ends at the other interest rate yield, you've flatlined your yield percentage. But if you actually look at the arithmetic return over that time, it's higher than the yield, because of the fact that there's volatility in the return of the in the price as it goes through time.
Okay, so I'm buying that you're buying a yield to maturity. The yield to maturity is on a continuous contract. You're buying a yield to maturity. The yield to maturity is an expected geometric return, and but the security is going to fluctuate through time, and therefore the arithmetic mean of that security is higher than the geometric mean definitionally, and so you're just adding back half the variance to move from the geometric mean expected from the yield to maturity at each point in time to get to your arithmetic mean, and then that goes into your optimization.
Right. And all I care about is the short-term period. Like I'm only concerned about the return until I rebalance. So it doesn't really matter to me that my return over 10 years is actually fairly well known. I'm just worried about my return over the next week or the next month or whatever my rebalance period is. And in that case, it's actually going to be higher than the geometric return. So that's that input.
So why is it going to be higher than the geometric return?
Because there's volatility in it. Because there's volatility, the arithmetic mean will be higher than the geometric.
Oh, I'm sorry. The arithmetic return will always be higher than the geometric return over the
right. And the input, the inputs into the geometric curve we were talking about earlier is arithmetic return, not geometric.
Right. Absolutely. Got it. Okay. So I was wondering how you think about gold. How do you set an expected return for gold?
Yeah. So I that's one of the biggest questions I get. I don't have a really good answer. I think if I did, that would be great, because I've not found anybody that has any real good way to estimate that. My estimate, that's one of the weaker places of the entire strategy. I will fully admit that. It's based more on monetary growth. That's just kind of where I think that it makes sense, and it's got all sorts of errors in it. It can go for long periods of time being absolutely horrible. It seems to be reasonably good over long time stretches, but it certainly makes mistakes at times. I've done a lot of poking.
But you're using some kind of M1, M2 proxy type.
Yeah, somewhere around those ideas.
Macro variable, right?
I mean, I've thought about a lot of things. I've thought about just giving it something over the risk-free rate, saying that it's like inflation plus the risk-free rate or something like that. So one interesting thing, this strategy has been the same for a little while, but since joining Twitter and writing the blog, I've reached out and heard from a lot of people. I've learned a lot more. One of the things I'm going to get into shortly with my own strategy is trying to figure out how to turn into a bit of an ensemble, since I have multiple concepts of what makes sense, and I have trouble figuring out which one, and gold return is a perfect example, which one is the best choice. So I didn't know anything about ensembles when I started this. I didn't think they actually made sense the first time I heard you or Corey or anybody else talking about them. But the more I learned about them, I was like, all right, this is actually pretty smart. And so I'm going to try and incorporate that in. So future, I'm going to try and come up with, anything that I had that I thought made somewhat sense. I'm going to try and figure out a way to ensemble it into a future. Future version of the strategy.
So the geometric rebalancing as it stands has U.S. equities, 30-year bonds, and gold and cash.
Yes.
And so are you incorporating the cash into the portfolio directly in the optimization, or is that a optimal Kelly leverage question that comes after? I mean, you can kind of do them both in one step, I know, right? It's really just the inverse of the covariance matrix times the expected return vector gives you, in fact, your weights and also your total leverage, but doesn't work so well. That works well if you're willing to leverage, but doesn't work in the no leverage constrained version. So I'm just wondering, how do you separate those two if you do?
Yeah, I do. I may rebuild it so that it's more one action, but right now it's more pick the portfolio off the assets, and then figure out if I want to scale it. I mean, so there's two versions of this. There's a leverage version too, where I'm openly on board with levering it, which I have not talked about much on the blog. I've referenced it once or twice, but I'd rather just deal with at least publicly talking about the non-levered version, because I think it's a better place to start thinking about the topic. But the leverage version has to think a lot more about, how much do you borrow and when, and it's a lot more thinking about that with the portfolio construction. But the unlevered version usually picks the portfolio and then decides if it wants to scale back and add leverage, add cash to so cash comes in for two reasons. One, it sometimes does it. It's got to be a pretty wild market, but it will sometimes do it just off of the idea of this will actually help your return.
And you're thinking
it'll
about it from a portfolio standpoint. So what's the optimal Kelly of the portfolio? Or are you looking
Yeah.
at the individual assets?
No, from the actual portfolio, from the Kelly portfolio.
So
I mean, it's playing off
at
the assets too. So I do have that one post where it's got the two assets in cash. I cut a corner because I didn't want to deal with the complexity of correlation and how that messes with the way it goes. But it generally covers the concept. And if you take the formulas that I posted on that, yeah, it's actually saying if the market is extremely volatile and cash is reasonably close to where we think the expected returns on some of these assets are, it'll pull it in based off of a Kelly perspective. But the second reason though is it'll pull it in because if it thinks that if it thinks that the whole portfolio is just too risky or it's too close to the peak, I've put things in there to add cash just to kind of pull off of it, to make it safer. And it did that some in March. March was a bit of both because it was so wild that it was actually thinking it was smarter to have cash in the first place, and then it got more aggressive in the cash just because the world was so choppy, and I don't feel like I want to deal with big drawdowns. So it just
did the cash come in before the big drop?
So my portfolio, I think, called cash to go to cash, some cash, not all cash. It never was all cash, but I think it was 30% cash on the 27th or 28th of February.
Okay, so after the vol began to pick up.
Yeah, it experienced a decent bit of the first down. And then the second down, it still experienced it. It didn't escape it, but it got up to 60% cash at one point. So the last third of it was a lot calmer. So
how do you deal with the leverage? I think it's a little easier with the unleveraged version, because you add cash as you need it, but you never borrow to lever up. But I mean, the optimal Kelly leverage can get really extreme at times.
Mm-hmm. Yeah. No, I
wouldn't use yield. It's
sorry.
No, I'm just saying, like, if you're using, you form a portfolio based on the current yield of all your different instruments, and then you find the optimal Kelly leverage, that can be well above 10, 15, 20 times. So I'm just wondering.
Oh, yeah, easy.
Yeah.
I wouldn't dream. No, I don't dream of going up there though. No, I just allow leverage. I'm not pushing up the curve up towards the peak. I think that. So I've had a few posts. I mean, leverage. I didn't like leverage. I used to think it was annoying and kind of scary. Once I kind of came around to the idea, and I think Rodrigo brought this up on your talk last week, that stocks themselves are levered already. That you just own the S&P 500 and you think you're not losing leverage, but you kind of are. Someone just took the leverage out for you. Once I kind of grasped that concept, I was like, all right, well, what's the big deal about levering up 20%? Like if I've gone through the process of building a good, strong, robust portfolio, what's the big problem with that? And I kind of become okay with the idea. But I say this, you got to be careful because, I mean, people can think that they've got a good, strong portfolio and you put too much leverage on it and it'll ruin everything. And it may be good most of the time, but leverage makes volatility drag way worse. It makes what I call error drag way worse. It exemplifies all the errors in your projections. So when I say, like, I'm not very good at projecting gold, which I'm not, that error of whatever mistake I made, if I lever it, I mean, I'm just making my error and multiplying it. So I really, I mean, in practice, and mind you, I've never put huge amounts of leverage on this portfolio. I even stopped last summer because business kept me away from actually being able to rebalance this thing as frequently as I wanted to, or being able to change it midweek if it called for an adjustment. I just capped it. I mean, I think the portfolio I actually posted the leverage back test for. I just wouldn't have let it go more than three times up. So I just said, this is your cap. You're not going more than three levered up. But I do, even if, let's just say that the portfolio calls for 3 leverage, it won't go there. It'll back off. It would never let itself go up to the peak because of the fear of the mistakes and the errors and just the unknownness about the future.
So say more about error drag, because I think you're starting to get there in your current blog series.
I posted on that yesterday. I don't know if you
Was it
yesterday
yesterday?
afternoon.
I think I read something about it. There was certainly, is that your Tiger Woods post?
Yeah, that's the one.
Right. Okay.
Yeah,
So
right.
get into that for me.
So I spent a lot of my time dealing almost from a gambling perspective, but just a specific, like you know the return, you know the standard deviation, you know the correlation, and then this is where you invest. And of course, that's not true in real life. So the question then becomes, what effect does that have? Like if you have, if you don't actually know, and you just think you're kind of going to be in the region of being correct on your estimate, what happens when it actually is 10% below where you thought it would be? What happens when it's 10% worse than you thought it would be? How does that affect the portfolio? And the interesting thing is, from a just from a pure standard deviation perspective, just to keep it straightforward, if you've overestimated the portfolio, or overestimated the standard deviation, so the world is calmer than you think, your portfolio is probably going to end up doing better than you thought in the first place, because the calmness of the market, this is all other things being equal, obviously, but just keep everything else equal, it's going to end up doing better, which is obviously good. This is a good error. But if the world ends up being more volatile than you expected, if it's more volatile than your projections for future volatility were calling for, then the portfolio is going to end up doing far worse, because the volatility drag will be much higher, and you'll get your returns pulled down. And this isn't meant to be like over a day or something. You got to have time to see this play out. But so the interesting thing, though, is that those two, the gains when the errors go in your favor and the losses when the errors go against you, are not equal. They are worse on the bad errors. The bad errors harm you more often. So because of that, it actually means that you're better off aiming left of the peak in reality, because the more you aim left of the peak, the tighter the error dispersion, the pain from the error becomes. So it becomes more similar, more equal. So you take less expected return, knowing that your errors are going to be tighter, or the consequences of the errors are going to be tighter. And this means that the peak is actually higher. So in the example I gave, I said you could go from a 62% portfolio of bonds and stocks. And this was just a generic example, but if you assumed that you only had 10%, your errors could be 10% off, you were better off being 5% conservative and being 43% in bonds.
And that was 10 percentage points, right? I think you were using
it was 10 percentage points,
and
not
10%.
Right, exactly. So it was saying that you expected the future to be 20% volatile, and then it ended up being 30% volatile, which to me is not totally, unreasonable at all. That kind of mistake happens. Far worse than that happens all the time. So
yeah, right.
So just in that example alone, it said be 5% more conservative on your allocation, on the lower vol allocation, and then in reality, because of that, you actually make a higher return.
Right, and just remind me, both stocks and bonds were 10% more volatile than expected.
Yeah,
right?
I kicked them both up.
Right. Yeah. Okay. Got it.
So
yeah, go ahead.
No, I was saying the whole thing to me is actually, that's where a lot of this gets really interesting, because the front end of the portfolio construction is not, there's some counterintuitive things to what I think I've done, but it's mathematically, I feel like a lot of the geometric return is kind of a known concept by a lot of people. And like you said, the geometric frontier it's not commonly used. I'm actually surprised I don't see it talked about that often, but it's not a new concept. But what really gets interesting is when you start trying to figure out, how do you deal with implementing this in real life, and dealing with the errors and dealing with risk tolerances, which I haven't really gotten into yet. But the whole idea of, okay, you're at the peak, but the peak's flat. So if you just move a little to the left, is it worth giving up a smidge of return for cutting your volatility down? And where do you actually find that trade-off? That's where this stuff gets really interesting from a portfolio construction perspective of, how do you do that? So that's where the future is.
And I think that's a real curiosity in the whole movement towards ergodicity economics, where at least my understanding is that they sort of reject the idea of utility in general, and that the only thing that matters is the expected value, and the expected value is the long-term geometric mean. And it seems to me like that can't be the only thing that matters, especially given finite horizons and individual preferences and I don't know. Like, what do you make of that?
Yeah, I've gotten a lot of discussions with people on that. I agree. I think I don't like utility theories. I do think that that's not the right place to start. I would have rather they started with a geometric return, which is from a utility perspective, a natural log utility, and then worked from there as far as risk aversion came from, as opposed to starting off of linear utility and saying you're risk averse from that point. But it is, when you look at the real world, it does seem to people still sometimes they have their instance where they pull off. I mean, even myself, I'm not investing at the top. Like, I'm not investing at the top because of the errors, and I'm not investing at the top because I think you should still pull off a little further, because I'm willing to give up a little bit of risk or a little bit of return for a lot less, volatility.
But I mean, like the Kelly, like assume the strategy has a 0.5 sharp, right? And I mean, the back test shows almost 0.9 in the leverage version over 1. Assume it has 0.5 sharp. The Kelly optimal leverage on that would be well above 3, 4, 5. And
well, yeah. So the Kelly optimal leverage would be to lever it up to 0.5 standard deviation. So that they equal.
So, clearly that's not where you're running the strategy. And it's not, I think, where most people would run the strategy, right? But I mean, that's where you would run the strategy if the objective was to maximize wealth and you didn't really care about intermediate drawdowns.
Right.
So, if nobody actually acts to maximize long-term wealth, then surely there must be a flaw in the whole idea that people don't act in pursuit of some sort of utility function.
I don't think I totally followed you there, but
nobody actually invests with optimal Kelly.
Sure.
Optimal Kelly says, I'm willing to tolerate a 99.9% drawdown because that is how I'm going to maximize my long-term wealth, right? And even if you sort of reduce your expected Sharpe ratio, reduce your expected return dramatically, nobody invested half Kelly. Very, very few people invest their full wealth at quarter Kelly. So given that that's true,
I don't know. I think there are people that invest their full wealth at quarter Kelly. I think there's people that invest their full wealth at half Kelly.
That's fine, but the vast majority don't. There are certainly people that do. Yeah,
so I'm gonna slightly disagree with you on that, because if on the stochastic efficiency post that I had, it effectively said that individual stocks are full Kelly, that their return is over the risk-free rate is dead on equal to their variance. So if you look at the S&P 500 from that perspective, S&P 500 is generally around a Kelly of calls for a Kelly of 2 historically. Rounding, but that's about what it is. So if you have people that are just saying, I'm just going to buy the S&P 500 and let it be, and that's my investing strategy, and there's plenty of people that's their investing strategy, right? Just buy the S&P 500 and move on. They're investing half Kelly. I mean, that's half the people. Like, you should, if you were just,
that's fine, but they've also neglected all of the other dimensions of Kelly, right? Like, they're not pursuing the max Sharpe portfolio. They're not.
Yeah. I agree with you on that.
They're not maximizing diversification. And so they're investing at half Kelly on a theoretically profoundly inefficient portfolio.
Yes. No, I agree with that. I'm just saying, if you actually look at their risk, what the risk that they're putting themselves through by just buying that, they have chosen to invest in about a half Kelly situation. They in my opinion, they should be diversified more with other stuff. But I think there's a lot of people that, if you buy just a pure stock portfolio, you're generally running around a half Kelly situation.
Yeah, no, that's a fair point. Yeah. I just think, like, for a diversified portfolio, half Kelly would see you lever, 5, 10, 20 times. So there's very, very few people.
So I think my strategy, if you were to full Kelly, it is somewhere around 10 on average. I mean, obviously there's times it's higher than that, times it's lower than that, but
Yeah.
It's somewhere around 10. So yeah, I mean, would I lever it 5 times to half Kelly? No, I wouldn't. But um, I do think that the whole the errors matter here, because if you make a big mistake with leverage, the big difference to me with leverage is leverage opens up, gives you the chance for negative, like total negative wealth. I mean, you can owe something on the back end. If there's no leverage, theoretically, you're never going to owe anything. You might lose everything, but you're never going to owe anything. And the ability to go negative, it just changes the calculus of it a little bit. You have to be a lot more concerned with where your bottom end of your distributions are going to be and where you're going to go.
Well, I mean, even at half Kelly, your expected drawdown is much, much, much lower than or smaller than
extremely
the expected drawdown from full Kelly, right? So
right.
Even half Kelly, really, if you're making conservative assumptions and you're running at half Kelly, then your chance of going bankrupt or having negative wealth are vanishingly small. And yet still almost nobody runs at that level of leverage, right? That level of exposure.
Anybody that's building a diverse portfolio generally doesn't push it up there. I agree. Yeah. I mean, there's something to be said too, though, is whenever you're going to use the money matters. And this is the infinite part of it that I think we kind of pulled off. But Kelly assumes you're just going to let this stuff run, and you're going to let it run for long enough that that you're going to see the whole world. You're going to see the whole distribution, the ups and downs, and you're going to get it, and you're going to get to the end. I mean, that's not necessarily life. I mean, you know, if you invest and then you get laid off and you realize, you know what, I'm retiring now, and I thought I was working 10 years longer. You kind of need that money now. And I think everybody knows in the back of their head that they've invested it, and it's hopefully not going to be used for a while, but that's not necessarily the case. And of course, if you're in a retirement situation, it changes it a lot more. Like drawdowns become way more important if you're retiring, because if you pull too deep and then have to pull your money out to live for a couple of years and it stays down, you've totally changed the entire trajectory of the portfolio. So I think that plays into the whole idea why you lay off.
But how does Ergodicity Economics account for finite time? Right? Like what's recommended?
I don't think they really do that well, to be honest. I've never spoken to any of those guys running the stuff over in the London Mathematical Laboratory, but no, I don't think they do have some interesting stuff on finite time. They've got some of the discussions about how stuff can curve through time, so portfolios can be expected to go up and roll over and curve downwards. But no, I don't think they say a whole lot about predictions of where people should go through time.
Right.
I'm hoping they go a little bit down that path. I mean, I've looked into that some. I do think it's extremely interesting to try and figure out where to go. The weird thing, though, is you can even make a case that over short periods of time, you'd almost rather be more aggressive in a way, because the arithmetic return is much more likely to happen if you're just doing it over a short period of time. Like the expected nature of the geometric return requires time for it to be true. If you're only doing something over one period, your expected return is the arithmetic return, which is higher. So, and in that case, then the whole utility concept makes some sense. But
well, if you're only doing it over one period, then there is no distribution, right? There is just one single path.
There is. If you're standing here saying I'm only going to invest for tomorrow, like, then it's just one. So like you're likely to get a higher. You should expect the return of about the arithmetic return of the higher return. But if you're expecting to go back and forth and experience volatility drag, then you should expect the geometric return.
Okay, well, there's something interesting there, but I'm gonna move off because I'm super curious about the degree to which the performance of the geometric rebalancing strategy is dependent on reasonably good return estimates versus just the diversification and rebalancing properties of the portfolio. In other words, if you use weaker return estimates, do you still get most of the benefits? And I ask because, for example, we spend a lot of time talking about risk parity, and so
you're agnostic on that, right? With
variance or inverse
volatility.
Yeah, it's not really that you're agnostic so much as you assume that
there's a different
returns are proportional to risk, right?
Either equal Sharpe or equal return, right?
So equal Sharpe if the markets are uncorrelated.
Yeah.
But the really, so risk parity is mean variance optimal, and therefore is Kelly optimal when expected return is proportional to volatility or proportional to expected risk. And so I just took a bit of a detour and said, well, what if I just use that as a way to form the optimal Kelly portfolio? And that wasn't like in a max Sharpe framework, it was great. In a max geometric return framework, I always just ended up with a single asset, right? So that way, that sort of more naive way to try to express a relationship between risk and return or derive a return estimate did not play well with maximizing geometric return. So I'm just wondering, I also experimented with just using earnings yield on equities and carry, the futures carry between the front and back month gold future and the euro dollar yield and like a couple other things, and use those. And that certainly got much, much closer to what you have shown in your blog. Mm-hmm. But how I tweaked those still made a difference. And then the optimal leverage that was derived from that setup was, on average 10 or 15 times, which was just absurd. So yeah, I'm just kind of curious, how much experimentation did you go through in order to find return estimates that played well in the backtest?
Well, so two things. I did some back tests to figure things out, but generally speaking, what I'm trading is close to the first effort that I threw out there. I kind of, as I talked about, like, I don't know how to deal with gold, so I came up with some ideas. I mean, even with equities, it's hard. I don't know. So I came up with a handful of different ideas of what to do. And I said, all right, what's likely the best? Like, if I had to pick based on what I know about macroeconomics and whatever, which one would I say is probably the best? So I picked it and I ran with it. And I said, all right, that's pretty good. I like that. That's nice. So I left that and I said, let's try some of these others. And so I threw them in there to see what would play out with it. And they were in the same neighborhood. Some were better. I mean, I could have put Sharpe ratios better than what I've got, but I figured that my first gut feeling was the other one, and it was good, and I didn't want to just pick something because the Sharpe, was better on the back test. So I stuck with my first gut feeling. To answer your question directly, I do think it matters. I don't think it matters a lot I think that picking the individual choice for the return, as long as it's reasonable, isn't that important over the long term, but the long term is probably many, many, many years. So when it comes to risk parity type portfolios, I like them. I totally understand the concepts of why they're set up. I like the idea of inverse variance portfolios. I like the idea of inverse volatility portfolios, maximum diversification. They all make sense. The thing is like I think you said, there's an assumption buried into every one of those about returns, that they're equal or equal or equal risk return or there's some kind of assumption in there. And I've never liked those assumptions. I've always thought that they weren't perfect. I mean, the idea that everything has equal return, I feel like, generally speaking, more risk gives you more return over time. And then equal Sharpe, I've never totally bought off on that. I get the idea, and I think it's a pretty good starting point, but because of some of my dichotomy with the stock market and stocks are not the same thing. To me, I'm not really sure that a long-term treasury bond should have the same Sharpe as the stock market index, because it's a combination. It's already a portfolio. It's like you have a single security versus a portfolio.
Right.
And,
okay.
And so I to me, that's like, it's a fine starting place. And I actually think it's reasonably true over long-term also, but short-term, I think that things get off. And I think that I think I'm better off trying to come up with something that's maybe a little bit better than that assumption. So that's where I'm at. I do think it matters a little bit, but I don't think it matters as much as some people think, as long as you're in the ballpark, because if you just look at the geometric, the formulas for creating a geometric, frontier, you're squaring volatility. You're not technically squaring, I guess you're squaring covariance, aren't you? I don't know. Either way, like the look of it, I feel like that those variables actually affect the portfolio more than returns. That if I'm off by returns by, 2 or 3%, it's not the same as if I'm off by, and that would be a 20% error, I guess. It's not the same as if I'm off by standard deviation by 20%. The impact of the portfolio is far larger if you made a mistake on the standard deviation. To me, that's the way I see the situation.
I think it'd be a really good post for you to go back and look at Chopra and Ziemba, 1993, where they showed that the errors and means are depending on your risk tolerance. So the risk tolerance you're using to express the optimal portfolio weights can be 50 times larger than the impact of errors and covariances. But that's in weight space. It's not in mean variance space. So there's some nuance there, but I think it'd be neat for you to go back and look at sort of different return estimates and how that impacts either the constitution of the portfolio through time or the performance through time and what that error term looks like. But on that note, I was curious about, because I'm actually writing a fairly involved article right now on how to evaluate risk parity strategies. One of the things that I'm trying to drill into is that how you form the portfolio will have an impact on the average portfolio constitution over time. So for example, inverse variance weighted portfolios have an extremely high long-term average weight in bonds. And bonds have had a very high Sharpe ratio over the full history of our simulation. And so portfolios that have a larger strategic allocation to bonds have a higher average long-term Sharpe ratio in sample over our evaluation horizon. But we shouldn't derive too much information from that because, of course, we know that current bond yields are very small relative to where they were at the beginning of the simulation. And so we know that the forward returns from bonds are lower. And also the purpose of the risk parity portfolio is to be resilient to any of the major economic regimes. And I know that that's the stated purpose of the permanent portfolio from Harry Brown. And I'm assuming that is one of the reasons why you've chosen that asset class universe, right? The cash and gold and stocks and bonds, because you want to have assets that are designed to be resilient to any of the major economic regimes. But sometimes you can't tell from the simulation exactly how resilient the way you're constructing the portfolio from these different investments is actually making it resilient to the economic regime. So I'm just wondering how much of the risk and return from your method, the geometric rebalancing method, is derived from stocks versus bond versus gold, or have you done any experimentation to see how the portfolio performs in different economic regimes? For example, when 12-month inflation, inflation over the past 12 months is higher than inflation over the past 36 months, which might represent an inflation surprise, or GDP growth over the past 12 months is higher or lower than what it's been over the last 36 months, which might represent a growth surprise, right? I think that'd be also another really interesting way to look at it.
So I totally agree with everything you said. I'm using the 30-year bond for the portfolio, mostly because it kind of acts as a levered 10-year bond. It's generally speaking about twice the movement and twice the return of the 10-year bond. I have done this entire portfolio and ran back tests on it using the 10-year bond back into early 70s, 71, I guess, with gold. And then I've thrown gold out and taken it back into the 60s just to see how it handles back in those times. It certainly is worse. The high interest rate environment with rising yields is not a fun one for getting good Sharpe ratios out of it. I felt like it still performed as I would hope. I mean, it like I said, the tailwind we've gotten from falling yields is awesome over the last 40 years. I mean, we're not going to see anything like that for probably another 40 years. So it's definitely would be worse when that happens. And when inflation kicks up, it's not going to be as easy to go through. The hope, somewhat like you said, is that gold can handle some of that other side. I mean, shoot, I don't know. Gold may not always roll up in inflation. I think we think it does, but it could easily not. It kind of has in the past, so we're hoping it does it again.
Also, I think that you're not really, you're explicitly benchmarking it against U.S. equities or perhaps a U.S. 60/40 portfolio, which definitionally is designed to perform much worse in inflationary stagnation scenarios or even in deflationary scenarios. And so, really, when compared with other common options, the geometric rebalancing portfolio is designed to be more diversified and has the opportunity to gain exposure to markets that are fundamentally designed to thrive in very different economic environments, right, in a way that traditional portfolios are not. And so I think you can sort of lean into that argument.
Right. And one thing that I try and sample the market a lot. I mean, I have what most people consider would be short time frames that I'm pulling data out of for correlation and standard deviation. And I am willing to change it every single day. It's built right now that I'm running to do it every week. But if the market moves fast enough, I'll move it because I don't want it that far out of whack. And I honestly think that matters a lot, because if you're using long-term predictions of these things, the market can change pretty quick. And quite frankly, the data from more than a year ago doesn't really matter about. It doesn't tell you anything about today. So in some kind of environment like that, where we start getting inflation and the assets correlation with each other starts changing and the volatility moves, the hope is that I'm monitoring the market enough that I start to pick up on those differences and realize the portfolio can't be a standard portfolio that we're dealing with.
And there's nothing really in the design of the portfolio that would lead you to believe that there are any systematic biases, right? Like in the way that, for example, an inverse variance weighted portfolio is obviously going to be massively overweighted to bonds, right? So there's nothing in the design of the geometric balance portfolio that would lead to that type of systematic bias.
No, and as far as like types of portfolios, I think it's been 100% stocks once, not for very long, but it can go aggressively stocks. It can dump them pretty much entirely. It can be way high bonds. It'll move all over the place. It's not biased towards any of them. I think the biggest underlying assumption in the whole thing is that correlation and standard deviation are somewhat predictable, like that they're somewhat, based off of recent stuff. Right. If that blows up, my strategy is no good. That's the basic assumption, is that they're somewhat there, and that the macro views for returns are close enough to, to keep you in the right area.
You should explore using a dynamic control mechanism where you introduce an overlay function that is determining whether your covariance estimates, you're getting good covariance estimates from your estimator. And if you aren't, then you know what the bias is and you can adjust for the bias dynamically. As an engineer, I think you'd really take to that.
That is an area I really want to get into. There's a lot of areas I want to get into, but having an actual engineering job and a family, there's only so much time I have to poke at. And I think that there's lower hanging fruit than that right now. But that's apropos of the Tiger Woods post that I just talked about. Knowing like where things are changing and how fast they're changing and how off you are, is huge. And I think
huge information. Yeah.
Yeah. And it can make you, like, you're talking about not wanting to lever up to the high level perspective. If you really believe and you can get good, tight information coming into your system, you can be a lot more aggressive if you think it's legitimate. That is on the list of, I wouldn't have phrased it exactly like you did, but I think that's probably
worthy to explore.
Yeah.
I'm curious, you've had fairly strong views on factor investing in general, right? You've commented specifically on momentum, but what are your general views on that?
So
feel free to speak candidly.
Yeah, no, I think factor investing is, I mean, obviously the data is there, you can see it. I feel like that it's focused very much on the arithmetic returns. I feel like I've seen some of the bigger people comment on that once before, and they say that they thought it was fine because you're just going to throw them into a portfolio and then rebalance that portfolio every now and then, so it doesn't matter. But to me, the geometric return shows itself reasonably fast. So unless you're rebalancing the portfolio pretty quickly, you're not going to get the full experience of the factors. I just think it's interesting when you look, and I've written more about momentum than anything else. I've spent a lot more time looking at momentum than anything else because I kind of wanted to think that it was, very useful, but I haven't been sold yet. But I mean, when you look at papers on momentum that find that the more often you rebalance, you get a better return. And I mean, I've just never seen a paper acknowledge that that's actually what you should expect. That's not surprising. That's not necessarily the momentum is fading. It is just literally what would happen when you're rebalancing a random return stream more often. You would see higher returns.
Right.
And it's so I think that some of that you can find that in some of the other factors also. That if you go back and you find that you've got these good weekly returns or daily returns on these things, and then people implement them, and of course you can't necessarily take a portfolio of 50 stocks and rebalance it every week. Your transaction fees would be through the roof. So nobody implements it that way. They implement it with a longer term outlook and a different setup. And then of course the implementation comes in, and is it really much better than investing in the market once it's been implemented that way? Well, it's hard to tell. And I think that that's where some of the reason why people have academic papers that look real good on factors on paper, but then when you implement them and you don't necessarily rebalance them that often, and you don't really know what's really coming out of what's the root driver of some of this stuff, that it doesn't play off as well. If I had time, I'd love to look into factors a little bit in internal correlations, because I feel like that's like when you look at momentum, I feel like that if you'd have to understand the internal correlation of the stocks. I mean, if they are predictable, I feel like if you're tracking that and you get momentum, if you get correlation internally moving against you in a position that's not good for the geometric return of the portfolio, then you could make adjustments and change things, and then you're harvesting the momentum on the good times. But then when you see correlation start to move against you, you take action so that you don't get the momentum crashes. I guess that's what people call them when things just drop out from under you.
Well, I mean, I can tell you from our own work that going back to the 1960s and rebalancing the portfolio about 1/12 of the portfolio every month. So in other words, it's sort of annual rebalancing, but tranched so that 1/12 of it is rebalanced every month. That a momentum portfolio that emphasizes stocks with high momentum while maximizing the Sharpe ratio. So really you're maximizing the momentum characteristic of the portfolio while simultaneously minimizing volatility, does substantially better than just an equal weight portfolio of high momentum stocks when you view it through an efficiency lens, right? So the Sharpe ratio of that is 50 to 65% higher than just an equal weight version. So accounting for some of that diversification is certainly beneficial, but I think it would be worthwhile to perform some kind of decomposition a la kind of Bernstein, where you back out the rebalancing bonus, right? And and then see what the incremental improvement from just identifying momentum as a characteristic is, how accretive that is to the portfolio relative to the rebalancing bonus. I think that's a really good question. Okay, that's fair. So shifting gears a little bit, because you have posted on some of Ole Peterson's sort of economic or wealth distribution papers. Is that an area I would be keen to go into? that I'm very interested and passionate about it.
I think you retweeted my one from about 3 weeks ago on that. So this is just really a think piece. I'm not very political, and I don't know a whole lot about wealth distribution actually, but if you have a random system with compound growth, then over time, unchecked, all wealth will cluster in the same into one single entity. So and you know, so what that means is you know, what that means is you're going to get wealth inequality. You're going to get the rich getting richer and the poor effectively staying the same. And more time, you're just going to, the rich are going to be more rich. And it's not because of anything more than randomness. It's just the nature of just random returns.
Well, I think let's invert it slightly, because I think what we can safely say is that even if every participant or every agent in the market has an equal a priori productive capacity, in other words, there's equal merit to their product.
Mm-hmm.
They have equal talent and equal effort. Even if that's true, that the wealth distribution will converge to the point where a single person or a single agent will own all the wealth in the economy, and everyone else will have asymptotic wealth to zero.
Yes.
Right?
Yeah. Right.
Even if everything else, the starting point is equal. It doesn't mean that it is equal in reality, but this is true even if it is equal. And I think that's the huge, profound, mind-blowing takeaway from some of this research.
Right. So and Ole Peters has done some stuff on that. And what's interesting is if you look at the wealth distribution in the world today, it is kind of roughly distributed the same as it would be if it was pure randomness. Now, I'm not trying to say it is pure randomness. I'm just saying it kind of looks like it could be. Like it's hard to distinguish skill from randomness in that front. So if you just look at it from that perspective, then and kind of tying back into my whole idea of portfolio construction from a society perspective, just like in a portfolio perspective, concentrating your wealth into one single, asset and not being diversified is not, generally speaking, a good idea. It can be just fine over the short run, but long run, your growth rate is going to be poor. And so if you're looking at it from a society perspective, you come up with the same kind of concept. There's a wonderful video called The Farmer's Fable, which talks through this from a very
hoping you were going to go into it.
Two-person perspective. But if you're sharing the wealth, if effectively you don't allow the wealth to become unequal and one side takes it all, the compound growth rate of the whole system, the society together, grows at a faster rate if everybody has got equal wealth. And the first time I realized that, I was like, well, that's really kind of interesting. It actually explains a little bit why when you're just looking at like tax structure and things like that, it can make sense to actually pull more money off of, high income people and distribute it back down through whatever programs are giving it back to the poor. Like there's mathematical justification for all that. And you can show that society as a whole will grow better because of that. Now, this is once again, just a straw man kind of model of the world. The world's a lot more complicated than that in reality, but I think it's really intriguing to think through that process because it's not what's intuitive. Like the intuitive thing is that the people in the past,
wealth accrues to those who have more merit.
Right. But see, so I find the really interesting thing is even if the world has people with more skill at doing good things for the world, which would be closer to my actual view of the world, that people like Steve Jobs do wonderful things and create products that help everybody, and I'd very much like it if they can create Apple and do their thing. Even in that world, the wealth still has to be pulled back down to everyone, or else it just all accrues to one person, and that doesn't end up working out well in the long run if it's not distributed. So just like my portfolio construction concepts say, try and spread the wealth, not dead on evenly. I mean, I'm making picks, but at least keep it, together and you spread it out so that it grows the compound growth of the entire portfolio. And in doing so, I'm constantly selling off the winners and moving the money back. If you just look at the actual function of it, I'm constantly selling off stocks in a normal environment, selling off stocks and buying and transferring that money back to other assets. If society is built the same, would work through the same mathematical functions, it should kind of be structured with the same concept of pulling wealth back down from the top back towards the ones that aren't as lucky. To me, the easiest way to think of it is if you got really lucky on the upside, some of that luck needs to be passed down to those that got really unlucky on the downside. And you're really balancing luck. Like you leave you get what your skill is, you get what you keep, what you earn. But if there was luck involved, now how you implement that, I don't know. I mean, this is purely
you trickle down
mental thought
resources
process,
to those who then have an opportunity to get lucky, right? Or
right.
It's some combination of effort and luck, right? Luck acts as a force multiplier on talent or effort, or the combination of talent or effort. And if all of the wealth is concentrated in a small number of hands, then you don't get the opportunity for that force multiplier to work in the random population at large. There are other people with merit and with talent and who are willing to put in the effort and are going to innovate and create capital formation. And those people don't get a chance because all of the wealth and therefore the force multiplier on luck is concentrated in a small number of hands, right? And so I think there's that's a balance that we probably should think more about how to do a better job at striking. And if we could do it properly, I think the really counterintuitive part, which you've highlighted, is if we do that properly, we actually get a higher growth rate in the economy. Mm-hmm. So it's not like you're sacrificing economic growth in order to have a fairer society. You get both a fairer society and faster economic growth in aggregate at the same time. So it's and 1 + 1 = 3.
In theory, even the rich have a higher growth rate under that world, which is not what you would expect. But like everyone grows faster if you're sharing and cooperating. That's what the whole post was about. Ode to cooperation. It was about effectively, if we all cooperate and work together, you're going to end up, the whole society and even individually ends up better in the long run.
Yeah, 100%. Well, this has been fantastic. We're about an hour and a quarter. So I think let's put a pin in it, and hopefully we can circle up for a round 2 at some point in the next few months.
Yeah, definitely. No, this was been fun.
What are you working on now? Like what do you figure is the low hanging fruit for, I guess you've got one more article in your series coming up. Do you want to give us are you talking about
with the errors and things?
No, well, that was post 2, right? Wasn't it a 3-part series?
Yeah, I think it's gonna be 4-part. I'm still deciding. I actually wrote that whole post as one series and decided there was too much, and I couldn't dump that much on people at once, so I broke it up. So no, the next one's going to talk a little bit about the peak and the fact that it's actually flat. So theoretically, you shouldn't be investing somewhere that you can invest at a lower return. So then I alluded to this earlier. Yeah, right. So how far do you go left? What do you accept? And then the other one's going to be talking about foundationally half Kelly, but I'm going to break it off of an engineering concept of stress and strain in materials and how they have an arc that looks a lot like actually a Kelly curve, and you get up near the yield and elasticity points and it'll break. And when you're designing something like that, you want no part of approaching that. So you build in a factor of safety to break off of that point, and how you decide what that factor of safety is so that you actually build a system that's not going to collapse on itself. And it's so tying that into the concept of portfolio construction like you would from an engineering side.
Fantastic. That sounds like, I'm looking forward to that. That's great. All right. Well, Matt, thanks again.
Thank you.
And I know we'll carry this conversation on through Twitter and hopefully get a chance to do this again live. Yeah, for me too.
Yep. Thank you.
All right. Well, enjoy your evening, and we'll chat soon.
Yep. Thanks.
See ya.
Bye.